Welcome to the course Computational Finance. So in this chart scenario, you are going to see what are all the practicals conducted inside the classroom, as well as the core exercise relating to the computational finance. As you know, there are 12 exercises. That means there are 12 practical exercises, which is included in the full syllabus. If you gone through the syllabus, the entire part of the syllabus has been converted into 12 practicals, except the last unit. Okay. So the first practical is concerned about the return on investment using dew point analytics. You might have studied about the different accounting ratios. So in this exercise, we are going to use the accounting ratios, how you can calculate the return on investment. That is the core aim of this exercise. The input for this one is you can take it from any company's balance sheet, either available in yahoofinance.com or moneycontrol.com or Microsoft Finance, whatever it may be. You have to input the different components here. That is especially the gross revenue, variable expenses, fixed expenses, interest expenses, other operating income, then total assets and liabilities. It will calculate the exact return on investments, that is return on assets and return on equity correctly. That is the analysis part. Coming to the analytics, for which purpose we are using that one. We wish to find out what is the desired income for the expected profit. So we are giving the input what will be the expected profit we are expecting from our investments. For that, what will be the revenue? So we have to find out like that. Once if you identify the income, based upon that, we have to work out whether we are able to achieve that one. That is the core aim of this analytics. Usually we can use the solver function in Excel, and the summary you can prepare with the what if analysis. And the criteria addition, it is based upon the asset turnover. What is the efficiency of the organization for the desired income? Okay, you can see the output of that one. You will get what will be the return on equity, so that the organization can plan what will be the desired income. For that, they have to inform to the marketing department and take necessary steps to improve the income. So the deciding factors are all the ratios. So these all the ratios are very essential to take the decision. So in this analytics, you have to write about why we are calculating the return on investments, what are all the different types of ratios included, and what is the expected formula. At least you have to mention we are going to calculate this return on equity, all those things. Then the analytics regarding this exercise. What will be the desired revenue to achieve the particular return on equity? Okay, that is all coming under the first part. Coming to the second exercise, it is relating to the capital budgeting. You have studied about the capital budgeting. There are different methods of capital budgeting. Here we are using the capital budgeting technique. You can see that one. You can calculate the payback period. You can calculate the internal rate of return. That is for the purpose of decision making. So the analysis include determining the payback period, determining the net present value, determining the internal return of return. But coming to the analytics part, why we are using the capital budgeting? Here also same thing. If you are expecting some internal rate of return, what is the expected income we are expecting from this asset recurringly throughout the lifetime of the asset? That is very important. You are buying the asset, you estimate that the asset will go for 10 years. So within 10 years, how much income the asset is supposed to gain? Then only we are able to plan whether we can buy or not. It is based upon the internal rate of return and IRR. Even you can calculate the payback period. So that is the analytics involved in this. Output, you can calculate the IRR, NPV. Even you can present this one in a waterfall diagram, which will show clearly that what will be the desired and expected income for a particular return on investments or IRR from a particular asset. That is the final one. So you must know what are all the input. You have to give the input about the what is the initial investments, what are all the cash flows from that asset, how many years the asset can be utilized, then what will be the desired expected cash flows in each and every year. Once we estimated, then we can go for the analytics. So when you are performing analytics, you have to prepare the summary statement regarding the what will be the decision on desired returns. The next exercise is about the cash flow estimation. Any organization, we have to estimate the cash flow, which includes cash inflow and outflow. You can see the cash flow estimations are done for the revenue expenditure. In previous case, we discussed about the capital expenditure. Here we are going to discuss about the revenue expenditure. So how to estimate the revenue expenditure? You can see in this chart, you will be given the net sales, that is income from operations, what is the consumption, what is the purchases. All this information is given. Usually it is the replica of the trading account. So our aim is how we are able to control the future revenue expenditure. That is the aim of that one. So we are forecasting the sales because sales is said to be the independent variable. So here we are forecasting the sales first. Then we are going to take decision. What will be the sales? And then what will be the desired revenue expenditure for the particular sales? The output you can generate in the form of graphical one. Even you can use the one in case of the e-views. You can use that one and estimate what will be the estimated cash flows of revenue expenditure. This is a nice tool used for that one. Only one thing you have to understand here, you have to give the input of the estimated sales. Estimated sales is an independent variable, so you can use the Excel to forecast, but capital expenditure is different. Revenue expenditure you can estimate with the help of the sales. That is why we are using the E-views and ARC modeling for this purpose. Coming to the next exercise, it is the break-even point. You know about the break-even point. There is no profit or no loss. That is the meaning of break-even point. So here, why we are calculating the break-even point? Anyhow, you know the input about all the fixed expenses, variable expenses. If you input that one, you will get nicely the break-even point. That is the analysis part. But coming to the analytics, how to control the overheads for a desired break-even point. That is the important thing. You are getting the data from the cost sheet. The metadata is the sales variable cost, then the fixed cost, then the variable cost as a percentage on sales. These are all the data you have to get. Then using the break-even Sales, you are deciding what is the minimum and maximum demand for the product expected in future, so that you have to plan accordingly in such a manner that how we can adjust or increase or reduce the overheads. That is the purpose of calculating the break-even point in case of analytics. Analysis, simply the calculation. You can see the output, you can create the output in different scenario. What will be the sales in a desired situation? You can calculate and estimate the cost of goods sold, labor and factory overheads in this level. What will be the controlling level? You have to estimate with the help of scenario. Only one thing, the fixed cost remains same. In other words, we can conclude that how we can maximum utilize the fixed cost to achieve the desired level of income. That is maximum utilization of fixed cost you can do with the help of this analytics. The next one is regarding the flexible budget. That means different levels of production, the expenses may change because we are having fixed and variable expenses. So flexible budget will tell about different profit level in different situation. So you must know the input clearly, materials, labor, factory overheads, all these things are said to be the input. The fixed factory overheads and fixed overheads you have to find out, it won't change. But coming to the analytics part, it is different. Why we are using the flexible budget from analysis? We used to compute the optimum level of production. What will be the optimum level of production for us? If your boss is asking, you have to inform. Maximum we can utilize this cost, both fixed and variable cost, to achieve the production level so that our cost we are able to control. That is the purpose. It is the next stage of the break even. Only one thing you have to visualize through the flexible budget. Even you can prepare the chart in different level, optimum level, what will be the production level for that one. That is the analytics. And see the output. You can present in the form of the graphics. What is the desired level and optimum level of production? In case of no profit, no loss, then if you want to achieve a particular level of profit, what will be the production we have to give? So you are giving information to the production department. That is the purpose of this analytics. Coming to the next exercise, it is the cash flow cycle. Cash flow cycle means how many days, how many months it takes to convert the raw materials into cash for the purpose of day-to-day operation. So here you have to find out the cash cycle, that is the calculation analysis side. It is based upon the inventory outstanding, that is DIO, then sales outstanding, DSO, then payables outstanding, that is DPO. You must understand two things, that is inventory outstanding and sales outstanding are coming under the customer category, whereas payable outstandings comes under the creditors. So that is the suppliers category. That is why we are using this technique to estimate nicely the what will be the cash cycle, that is conversion cycle. Inventory we may gain, sales we may gain, but payables we have to pay to the suppliers. So main data you have to understand is what are all the inventory outstanding, sales outstanding, and payables outstanding to the creditors. Understand that one. So why we are calculating this credit period and calculations, we are going to determine what will be the maximum credit period we can give to our customers. Using the analysis, the analytics we are using is determination of the credit period. So the output we are presenting in the graphical representation. What will be the credit period maximum we can give to our customers? Any organization, whether you are running a service unit or non-service unit, customers may ask credit. You have to inform them clearly how many days of credit we can give to our customers. That is the core aim of this analytics. Understand that one. You can see it can be prepared in the form of graphics. Maximum credit we can available to our customers. That is where these lines are meeting. You can see here in this chart it shows around 17 days. So that is the purpose of this analytics. The analysis is different, analytics is different. Understand that one. So we have to give in data regarding the inventory, sales, then payables. The output you will get in the form of nicely the credit days. So how many days of credit we can give it to our customers. Then next exercise is regarding the working capital estimation. That is day-to-day cash necessary to run our business. That is called the working capital estimation. So we can calculate the working capital using the traditional formula current assets minus current liabilities. That is the working capital. Simple thing. That is the analysis. But coming to the analytics, we have to estimate the working capital. So first we have to estimate the current assets, which is said to be independent. So current assets are independent. So we have to first estimate the current assets. Based upon that only we can estimate working capital. So understand that one. The calculation and the analysis is for working capital. But analytics is what will be the future working capital. Here we are using the concept of the working capital forecasting, traditional forecasting of current assets done by the Excel. Then for the purpose of estimating the expected working capital based upon the nearby amount, due weightage will be given to the nearby cash flows. For that purpose, we are using the ARC model. So you must understand why we are using the ARC modeling, that is autoregressive modeling. ARC modeling is used for the purpose of creating and finding out due weightage for the current one. That is, we are using the ARC modeling. The next one is the economic value added concept. I think you have studied what is the purpose of economic value added. It is based upon the intrinsic value of our capital requirements as well as the capital needs. So in case of any organization, they are calculating the economic value added, and based upon that they use to find out clearly what is the percentage of economic value added. So here, for which purpose we are using, that is the question mark. Analysis is simply the calculation of the value added. But here we use to find out how much investment we can use, or where, how many amount from profit we can reinvest and gain profit in future. We are having sufficient profits, but we can't utilize that sufficient profits for the investment. Here it will show clearly that how many amount from profits, what is the percentage from the profit we can utilize for the reinvestment. That is why we are using the NOPAT analysis. That is net operating profit after tax analysis. That is the aim of this economic value added. Analysis is calculating only EVA. Analytics is you have to estimate clearly how many percentage of profit we can reinvest in future. You can see that is the output. You can tell based upon the different alternatives. You can find out what will be the investment avenues. Then the core thing in financial management is the cost of capital. Simply the minimum expected return on investments. That is the risk-free rate. So analysis, it is very easy. We have to calculate the weighted average cost of capital based upon the different input. You can easily calculate the weighted average cost of capital. But coming to the analytics part, why we are using the weighted average cost of capital? Our aim is to find out what is the wealth we created. Because you know the objective of the financial management is to create the wealth. So the wealth maximization is very important thing. So we decided to find out whether we achieve the desired wealth. Wealth depends upon the market value of the organization. That is market value of the shares. So here you must understand when you are going for analytics with the help of cost of capital, what is the independent variable, what is the dependent variable. Independent variable is said to be uncontrollable, that is share price of our company. That you have to understand. So the main data we are going to get from the capital market, share price of the organization, which is said to be the independent variable. Based upon that, we are determining what will be the wealth. And the analytics clearly shows that if you want to get this amount of wealth, how much we have to increase the market value of our shares. You are estimating that our market value should be 2000 rupees. The present value is only 1500 rupees. That is the share price. If you want to achieve 2000 rupees in market value, what will be the desired income level as well as the wealth level you have to create? That is the core idea behind the calculation of cost of capital. So in this analytics, we are estimating nicely the cost of capital. Then we are using the cost of capital to find out clearly how much wealth we generated. If you want to estimate the particular wealth, how much our share price should increase. The next one is the leverage. There are two leverages, I think, you know, degree of operating leverage, degree of financial leverage. Combined leverage means combination of both DOL and DFL, that is the DCL. In the analysis part, we will calculate what is the DCL and DOL, that's all. For the given level of revenue and the given level of interest expenses, we will calculate the degree of combined leverage. That is the traditional one what we are using. Analysis. The analytics, we have to find out if you want to achieve the degree of combined leverage to 1, how much sales we are expecting. In other words, if you want to our firm to be leveraged, what is the desired level of revenue you have to generate? That is the analytics from this one. So our aim is to determine the revenue of sales based upon the leverage. If you want to achieve the leverage concept, what will be the desired one? That is why we are simulating with the help of sales and with the help of the desired leverage aspect. So input is the what are all the essential requirements to calculate DCL, that is DYL, DFL, then operating profits. All these things we have to give as an input. The output you are going to find out what will be the desired level of leverage. For that leverage, you can simulate clearly what will be the desired level of income. Even if you want, you can present in the chart form, but here she has made the analytics for the desired level of degree of combined leverage. What will be the then amortization schedule? Every company may purchase loan or borrow loan. They have to repay the loan in monthly installments. That is why we are preparing the amortization schedule. In case of analysis, what we will do, once if you input the loan amount, then the period, how many years, then how many installments if you input, it will clearly prepare the amortization schedule. How much amount you have to repay along with the interest as well as the principal amount. That is the analysis. It is based upon the time value of money. But here what we used to know, analytics side. It is used for number of purpose. One is loan amount. If you want to borrow a particular amount of loan, whether we are having sufficient income to repay the loan, we have to take the decision. You can't simply blindly say that I need 25 crores. But you have to understand whether we are able to repay the loan. The repaying capacity should be there. Otherwise, we can't repay the loan. So, as a good analytics students, you must understand clearly how much amount we are able to repay the loan. We need whether we are having sufficient income to repay the loan. Then only we can borrow. Understand that one. That is why we are calculating the loan schedule. You can see that one you have prepared nicely. What is the income capacity of the organization can be decided. So you can prepare the output chart with the help of the even the summary chart or with the help of nicely graphics also. What will be the loan amount we have to repay or how much income we need for first year, second year, third year, fourth year. Then we have to think whether we are able to achieve that income. If we are able to achieve that income, we can directly go for borrowing the loan. That is why analytics is used in amortization schedule. Coming to the last part, that is the time value of money. Of course, in your syllabus, it is in the first part, time value of money. There are two things in the time value of money. One is compound rate, another one is CAGR, compound annual growth rate. First, let us see the compound interest. It is very simple one. You have studied already in case of the school level. We are calculating the simple interest, compound interest. Compound interest means if you are investing 100 rupees, 10% interest, it will be added every year. That is compounded every year. Simple thing. Almost all the banks are using this technique to find out the compound interest. But here, for which purpose we are using this technique? It is entirely different. Most of the companies use the compound interest calculation techniques for the analytics of creating the sinking fund of the asset. If you are buying an asset, the purpose of buying an asset from the accounting side is to replace that one after the life period. If you are buying 10 crore worth of an asset, You are estimating that within 10 years we will replace the asset. So, but you must know after 10 years how much money we need to replace that one. That you must know clearly. Without knowing that, you can't do anything. That is why we are estimating clearly. That is how much amount we can set aside from every year from the profit and loss account in the form of depreciation for the purpose of replacing the asset. Every year we will set aside an amount from the profit and loss account. That amount will be deposited in the bank in the name of sinking fund. So after the end life of the asset, that amount will be utilized for replacing the asset. So the compound interest technique, that is the time value of money, is used to find out clearly how much amount we can set aside in the form of depreciation, otherwise in the form of sinking fund. So that is the purpose of this analytics. Analysis is simply calculation of compound interest, but analytics is different here. Okay, so usually we used to calculate the amount set aside every year for the purpose of sinking fund. Okay, the next part in the time value of money is compound annual growth rate. That is, what is the percentage of increase in sales, or what is the percentage of increase in the investment value. If you want to find out, that is the compound annual growth rate. This is the traditional one. It is based upon the time calculator. Same thing. So here, for which purpose we are using the compound annual growth rate? We are using the compound annual growth rate purpose. That is the analysis of calculating the compound annual growth rate to determine the income level. If you wish to achieve 23% growth rate in future, what will be your sales? Or you assume that your investment should grow at the rate of 18%. So how much you have to invest at present? That is the purpose of calculating the compound annual growth rate. Of course, we are using the no-pact method and we are estimating the growth rate. Even the profit, we are estimating that after 5 years, our profit should grow at the rate of 16%. So what will be the revenue level for that one? That is why we are using the compound annual growth rate calculator. Okay, that is the analytics. Based upon our discussion, you must understand what are the different computational finance analytics used. What are all the tools we are using in computational finance? We have discussed major tools and what is the purpose of using that one. The difference between analysis and analytics in each and every stage you must understand. So from the examination point of view, you are able to clearly give the purpose. Then very important thing, what are all the input for the data? Clearly mention what is the data, what is the metadata. Understand data is the source we are going to get. Metadata, what is the exact data we are going to use here. Then how we are going to simulate, what is the decision making criteria. Then what will be the desired expected output. You can think about your practical and write all those things in your exam paper. I hope you might have understand. With this, I am concluding the practicals and core discussion in the computational finance. Thank you.